Good evening, everyone. I am Thiago, and I'm followed by Thalissa and Thiago. It's with great pleasure that we present this live event for you today. First, I would like to thank our guest, Aswath Damodaran, for accepting our invitation. I would also like to thank everyone who is watching us today. It's an honor to bring you this content through our live events. So, for those who don't know, Poli Finance is the financial market club of the Politécnica School of the University of São Paulo. One of our primary goals is to get financial market closer to our community reality. For such, we have a project called Poli Finance Convida, which consists of several lectures with relevant people in the market to inspire and bring information mainly to undergraduate students. We have already talked to meaningful names like Roberto Setúbal, José Olímpio, and now we have the honor of receiving Aswath Damodaran.
So before we begin, I'll just make a brief introduction of our guest. Damodaran graduated in accounting at Madras University in Chennai, India, and he got his PhD degree in finance from the University of California, Los Angeles, UCLA. He's well known for his studies in corporate finance, investments, and valuation. He's also the author of several acclaimed books, such as Investment Valuation and The Dark Side of Valuation. Currently, he's a professor at the Stern School of Business in New York.
So just explaining a little the event structure, we will divide it into two main parts. The first will be focused on valuation with a particular emphasis on emerging countries, and the second will discuss the rise and value of companies in the technology industry. Lastly, we will discuss some questions sent by the audience, so please feel free to send us your questions through Facebook chat. But before we move on to these themes, Professor Damodaran, please tell us a little about your history and trajectory.
I always wanted to be a teacher. I actually, before I got my PhD at UCLA, I was an MBA, and it was the very last semester of my MBA program. And I was a TA for an accounting class because I needed the money. And I planned to actually, after my MBA, go on to become an investment banker, a consultant. But in that last quarter, when I became a TA and I walked into the classroom, I realized this was what I wanted to do with the rest of my life. I wanted to be a teacher. In fact, I still describe myself first and foremost as a teacher, not as a professor, not as an academic, not as a researcher. I'm a teacher first and foremost. So I got my PhD because I wanted to teach. And I came to NYU in 1986. And I came to NYU, they actually gave me a class to teach. It was a class called Security Analysis. For those of you who don't know the history of this class, it was a class that was started in the 1950s by a man called Ben Graham at Columbia University. You might have heard of him. And his most famous student, you've definitely heard of, a guy called Warren Buffett. So when I took a look at this class they gave me, and I said, I don't want to teach this class. It's the most boring class ever. Because by 1986, it was showing its age. It was 3 weeks on stocks and 3 weeks on bonds and 2 weeks on futures and options and 6 weeks in institutional detail. So the head of my department said, what would you like to teach instead? I said, I'd like to teach a valuation class. And in 1986, there was no full valuation class being taught anywhere in the world. And he said, don't do it. There isn't enough stuff in valuation to actually teach a class. And it was absolutely true. There wasn't enough stuff in valuation to teach a class, but I really, really wanted to do this. So here's what I did. I told him I'd teach his security analysis class. And I walked in, it was September of 1986. I taught my first valuation class. In the spring of 2021, I taught valuation for the 58th and 59th semesters of my life. And I'm going to say something about this class that's going to encapsulate how I think about valuation. Everything I know about valuation, I've learned in the course of teaching this class. I know it when I walked in. I still remember a day in 1987, October 19th, I'd come back from teaching a class. And at that time, NYU's business school was downtown right next to the American Stock Exchange. And I looked out of my window and every person on the exchange floor was out on the street. And I said, what's going on? Maybe there's a fire alarm. You know what happened on October 19th of 1987? The S&P 500 dropped 22% in one day. It was a one-day bear market. 2 days later, I was in front of my class. And guess what the first question I was asked was? How do you explain a 22% drop in the market using valuation first principles? And I had to talk about it. Then you get to the 1990s, the dot-com boom and bust. And I still remember the day in 1997, student putting up his hand saying, can you value this company Amazon.com using a discounted cash flow model? And I remember saying yes. And we valued Amazon that day in class. And everything I know about valuing young companies, I learned in the process of valuing Amazon. I came to Brazil for the first time in 1997. I still remember I gave my seminar in Rio. It was a 2-day valuation seminar. And for the entire 2 days, every question I was asked by the audience was about inflation. Everything I tried to talk about, it always came back to inflation. You know why? Because it's been only 5 years since your hyperinflation. Everybody was hypersensitized. Who cared about how companies were run? If you got inflation right, you're going to get rich. If you got inflation wrong, you're going to get poor. But I learned about inflation when I taught in Brazil in 1997. Every single thing I do in my class reflects what I've learned over the last 35 years teaching this class. In fact, most recently in 2020, we had a lab experiment we've never seen before. A virus was let loose in the world and the whole world shut down. Never in the history of the global economy have we ever had a shutdown like we did in 2020. And you know what? I had to talk about it in class. How do you value companies when the entire global economy is shut down? I've been a teacher all my life. And one of the things I've learned is every time I teach this class, there's something new for me to learn. It's not over. I have to keep learning. So if you ask me how I got here, it was incrementally. I never expected to get where I am today. But along the way, you take steps that move you in the right direction. Eventually, you're going to get someplace. And hopefully, I've got someplace.
Well, great to hear a bit of your personal experiences. So to start off, when we are actually looking at valuing Brazilian companies, we always have to take into account the risks of an emerging country. What do you think are the main variables that differ evaluation of Brazil compared to evaluation of a developed countries such as the US? You usually see discounted multiples in emerging countries. Would this normally be an opportunity? Well, what are your thoughts?
I'll be quite honest. I think every market, every group of investors thinks they're special. They think, you value tech companies, you think you need a special valuation model to value tech companies. VCs think they need a special model to value startups. Brazilian investors think they need a special model to value Brazilian companies. Indian investors the same way. I'll be quite honest. You know what drives the value of any business, no matter where it is in the world and what time you're looking at it? It's cash flows, growth, and risk. The difference is when you're in an emerging market, those cash flows, growth, and risk can be affected by things that the company doesn't control. That's really the only difference between an emerging market company valuation and a developed market company valuation. Is you're more at the mercy of what happens in terms of macroeconomic developments. That means you have less control over those factors. You can do everything right in valuing Embraer or Natura or any other Brazilian company. But if Brazil goes to hell in a handbasket as a country, it's going to affect your valuation. That's really the big difference. But here's what you can do. When you value a Brazilian company, you can't change those macroeconomic factors. You can't forecast the unforecastable. All you can do is demand a higher return for investing in the company and then let God take care of the rest. I have what I call the karmic view in investing. There are lots of things I don't control. If I spend my entire time thinking about all the things I don't control, I will never, ever complete valuing a company. I'll give it in the context of the US. In the US, a lot of people now are worried about interest rates and the Fed and what's going to happen to the Fed. You know what? When I value a company in the US, I don't for a second think about that while I'm valuing the company. Because if I do, it's going to be a distraction. How am I going to value Airbnb or Coca-Cola if I'm spending all my time thinking about what the Fed will do? And my advice to you if you're valuing Brazilian companies is don't spend all of your time assessing macro risk. What's going to happen to Brazil? Because the reality is none of us know, and you have a job to do. You want to value Natura, get to it, value the company. Let the macro variables fall where they might. But recognize you're going to be far wronger in emerging market companies, not because you're not doing your job, but because there are things you don't control.
So on the same topic, we know that when we are valuing a company, both quantitative and qualitative aspects are considered. So how much of the valuation process do you consider to be qualitative and how much of it is actually a number?
I'm not sure what the difference is. Give me an example of a quantitative process versus a qualitative process. Ultimately, everything's got to be a number, right? So you might get there by telling a story. So what exactly do you mean by quantitative versus qualitative?
So by quantitative, I mean like the number, like the percentage growth, but the premises you use to estimate this number as, for example, I think the revenue will grow by 50%. That is like qualitative. You certainly have
Why
like
is that qualitative? It seems like a number there too, right? Ultimately, it's all numbers. It's all about the future. It's all subjective. So I think the problem, and this is, I think, why engineers and mathematicians have trouble in valuation. They think that there are facts in valuation. Let me tell you the truth. There are no facts in evaluation. Everything is an opinion. Even your earnings last year is an opinion. You know why? Because an accountant estimated, there were judgment calls they had to make. Everything in valuation is an opinion. And by opinion, you mean you have to make subjective judgment. You got to tell a story. Absolutely. It's all going to be ultimately converted to a number. To arrive at that number, you got to bring in everything, you know, numbers, stories, qualitative, quantitative, but everything is in the future. And as a consequence, there are no numbers that you can draw on. There are numbers you can estimate.
And to guarantee that we are doing a impartial valuation, how can we guarantee that we are doing an impartial valuation? I mean, that our personal feelings about one company is not interfering on how we are evaluating it.
You can, in fact, I'll guarantee you, you're doing a biased valuation. All valuations are biased. There's no way you can hide from that. You know what you can do? Be honest with yourself about it. You can't make it go away. When I sit down to value Amazon or Apple, I bring in what I think about the company. And let's face it, I've had a long experience with these companies. I've known them longer than I've known my kids. I've been an Apple investor in and out since 1981. I've owned an Apple computer since 1981. It's impossible for me to be unbiased when I value Apple. So you know what I'm going to do? I'm going to value Apple with my biases, but then I'm going to try to be honest and tell you what my biases are. In statistics, there's a branch of statistics called Bayesian statistics. In Bayesian statistics, here's what you're required to do before you do a study or research. You're supposed to state your priors. In other words, before you run a research study, you're supposed to say, this is what I expect to see from my study. Now I'm going to do the study and show you my results. And the reason you do it, you want people to be aware of what your biases are so that they can then judge your results based on the biases you brought to the game. It's impossible to be objective. The sooner we let go of that, the quicker we can arrive at the conclusion that our results are biased. All we can do is be honest about our biases.
Well, so maybe switching topics a little bit. Recently, we've seen many companies being valued at a really high multiple, despite the fact that sometimes they're not even profitable, such as Nubank and, well, many other examples. Do you think people are acting irrationally and emotionally, or there's actually value within these companies? Are people buying value or emotions?
It depends on the company, right? I mean, it's very difficult to pass broad judgments. Who cares about a multiple anyway? Multiples are kind of the shortcut that lazy people used for much of the 20th century to invest. If you're lazy and you don't have the time to actually value companies, of course you want to buy companies at low PE ratios. It's an incredibly sloppy way of approaching investing, and it doesn't work anymore. So when I look at a company and I look at its cash flows, if all of its value lies in the future, of course it's going to trade at a huge multiple of what I see today, whether it's revenues or earnings or book value. So the fact that something trades at a high multiple doesn't necessarily make it overpriced. And just because a company trades at a low multiple doesn't make it cheap. So first, we got to let go of this notion that just because something looks cheap because of its multiple is low, we have to let go of that notion. We have to start thinking about the future. Are there some of these companies that are being overpriced? Absolutely. And the reason they're being overpriced is if you're in an upbeat market where everything is going well, people tend to get a little lazy, a little sloppy. They might pay too much for these companies. In fact, for some of these companies, I talk about what I call the big market delusion. I'll give you an example. Do you think the electric car market is going to grow a lot in the next decade? Absolutely. Why? Because we're increasingly shifting away from traditional cars to electric cars. So that macro view is right. Electric cars are going to be a big growth market. Does that mean that every electric car company out there should be worth a lot of money? Absolutely not. Because we don't even know how the market will evolve, what the competition will look like, what margins will look like, who will make the cars. But early in these markets, people will tend to look at every company in a market, give it a high price because there's lots of potential. But there's going to be a moment of reckoning 2, 3, 4 years from now. So lots of sectors, artificial intelligence, right now, COVID vaccines, electric cars, where there's a huge amount of hope about the future. A lot of companies are getting pumped up. Collectively, I think they're being overpriced, but doesn't mean every company in that sector is overpriced. So I think it is true that there's some overpricing going on, especially in disrupted sectors where you're getting these new ways of doing things. But I don't want to use the word irrational or bubble, because the minute you do that, you know what you're doing, right? You're setting yourself apart. You're saying, I am the smart one. I am the rational one. Look at these shallow people buying. No, I don't want to do that. Maybe they have a really good story for these companies. So I'm going to give them the benefit of the doubt. Those companies might not be the companies I would invest in, but who am I to wag a finger and saying you shouldn't do it? You're overpaying for these companies. It's not my money. It's not my job to go around telling other people that they're paying too much. It's their money. They have to make their own decisions.
So, and within these high growth companies, many of them might be profitable and successful in the future. So how can we actually find value in these high growth companies, considering that sometimes they do not even have a profit? So sometimes their free cash flow will be negative. And a lot of people say that DCF models aren't the best tool anymore to value them. So what's your opinion about it?
First, separate that into two parts. It's not even if you're a young growth company, your cash flows are going to be negative. It's a feature, not a bug. You know why your cash flows are negative? Even if you're making money, you're reinvesting huge amounts to get future growth. Negative cash flows are a feature at young companies and not a bug. It means nothing in terms of what the value of these companies is. The greatest companies, you see these trillion-dollar companies that you see out there, at one point in time used to be money-losing negative cash flow companies. So first, let's separate what value is from what the cash flows look like right now. You could have a negative cash flow company, which has a huge value. You could have a positive cash flow company that's not worth much. But to decide whether to invest in something, it's not just the value that matters, right? You have to look at the price. I say something that drives people crazy. I say, look, at the right price, I will buy any company. And I mean what I say. You give me a young, high growth company with lots of potential. Zoom. Zoom is one of those companies that has taken off over the last year because everybody's on Zoom. I think Zoom is a great company, immense potential. In fact, I think its value has tripled over the last year, but I wouldn't touch the company with a 10-foot pole. You know why? Because the price has gone up tenfold. I think it's overpriced. It's a great company that's overpriced. In contrast, you give me a company like Philip Morris. Boring company, not doing well. It's a tobacco company. People are smoking less. But its price is lower than its value. The story I'm telling for Philip Morris is not a great story. It's going to have negative growth. Its cash flows are going to decrease over time, but it's selling at the right price. Any discussion of investing has to bring in the price into the equation. I mean, I hear people, especially among the value investing community, say, look, just buy a great company, a well-managed company. That's all you need to do. And I think that's very bad advice. If you invest in a well-managed company that everybody else also realizes well-managed, you know what's going to happen? The price is going to get pushed up. Your best odds might actually be badly managed companies, but people have given up. You get it at the right price and you hope the management gets fixed. So we need to separate our discussion of what makes companies great from what makes investments great. It's a very different discussion because the former is driven by how well is the company run, how well is it managed. The latter is driven by what's the price relative to the value.
So still talking about the tech ecosystem, many companies have optionalities that may aggregate a lot of value in the future, but for now it's not a reality yet. So what is your advice for us to look at this optionality and value them?
Optionality is a tool that I use very rarely because I'll be quite honest, every 100 cases I'm told there's an option. Maybe there's one case where it actually makes sense. I'll give you examples where there's clear optionality. You look at a company like Petrobras, there's optionality. You know where the optionality comes from? Those undeveloped reserves that they have that right now are not viable, but could become viable if oil prices go back to $100 a barrel. There's clearly optionality in natural resource companies. You're a pharmaceutical company with a patent on a drug that right now you're not able to produce. It's working its way through the pipeline. There's optionality. Those are clearly options. But the optionality you're talking about is fuzzier. And I'll give you an example of a company I bought because of the optionality. I bought Facebook in 2018 after the Cambridge Analytica scandal. Remember the privacy issues, the stock price had dropped. I valued it 150, the stock was trading at 135. I bought it at 135. And I remember the blowback I got asking, how come you're buying with such a small margin for safety? Stock is almost fairly valued. And I said, look, I valued Facebook as an online advertising company to come up with 150. But there's a huge amount of optionality here. And they said, what are you talking about? I'm talking about the fact that they have a platform of 2.5 billion users who stay in their ecosystem about an hour every day. And if they can figure out other things they can do with this platform, maybe sell them entertainment, sell them news, sell them subscriptions, they could make a lot more money. Right now, none of those things are viable. But that's an option. Optionality requires exclusivity. I wrote a paper that's still on my website called Opportunities Are Not Options. And when I hear a lot of companies talk about options, they're talking about opportunities. I'm in a big market, therefore there's an option. No, that's not enough. You need a big market and exclusivity for an option to be in a valuation. And that's relatively rare. And when I do find it, I will add a premium to my value, but it's maybe 1 in 100 companies where that's going to be true.
Oh, okay. So actually, due to these expensive valuations, many companies are reaching the market really well capitalized and therefore seeking M&A activities to maybe accelerate their growth. What's the efficiency of this strategy? Are they actually reasonable? Should companies seek M&As?
Now, first, young companies usually are not looking at acquisitions. So it's usually older companies that have run out of ideas. Most acquisitions happen when older companies run out of projects in their businesses and they want to keep growing. So what they try to do is speed up the process. They go to an acquisition. Young companies are raising capital, but they're not raising as much capital as you think. Do you know that the typical IPO, less than 10% of the shares outstanding actually get offered on the offering day? That used to be 30, 40. When Microsoft and Apple went public, they offered 30, 40, 50% of the company early in the process. Now companies are offering much less. Most companies today are not raising that much capital from their IPO. They have the capacity to raise capital if they wanted to, but they're not raising capital. If they're doing acquisitions, it's not of other companies, it's usually of technologies that they need to keep going. So Airbnb, for instance, grows through acquisitions, but almost all of its acquisitions are technology components that augment its platform. So if they're doing acquisitions, it's of individual technologies, of patents, something that they can use to improve their platform. But I think the big difference, though, is companies are going public earlier in their life cycle than they used to. When you go back again to the 1980s, Microsoft and Apple did not go public till they actually were starting to make money. It was later in the process. Today, you have users. You might have no revenues. You could still go public even though you have no revenues because investors are willing to bet on you. Everybody's a VC now, even public market investors, and they seem to be willing to take bets on companies that only VCs would have invested in 30, 40 years ago.
So, still talking about tech companies, one of the factors that boosted them was the pandemics and the need for social isolation. So, to what extent do you think the changes caused by COVID-19 are permanent or are they just temporary?
A lot of it will fade. We won't know fully, but I think, if you're spending all your time on Netflix, you have a job. You can't spend all your time on Netflix and still have your job. So some of it will naturally go away. Some of it is here to stay. And I'll give you the example of Zoom. Prior to COVID, most companies, when they needed to have a meeting, would fly people from around the country, around the world to a physical location to meet. Because the conventional wisdom was, hey, there are a lot of older managers in the company. They will not get online. They don't like online meetings. They're not used to them. Then we had COVID. Guess what? Everybody had to learn technology. You couldn't say, I'm 65 years old or 60 years old. I don't look at my computer. You had to be online. And people found that it was not that complicated. So my guess is that a lot of people have Zoom meetings now will continue to have them after COVID's done, because it's so much cheaper, more efficient. In fact, there are some meetings you're looking and say, why did we ever get together physically? We could have done this on Zoom in 15 minutes. I mean, I'll use the perspective of education. Prior to 2020, if I said, people can get their entire degrees online, most people have said that's okay for some people, but most people need to be in a physical classroom. People cannot take classes online. And guess what? We've discovered that people take classes online. We've discovered some downsides, but we've also discovered some upsides. So clearly there are some things that are going to be permanent changes that are not going to go away. So I think that some of those benefits, and they're spread across companies, and they're not spread evenly. Some companies benefit, others don't, will stay on. Some will fade. DoorDash will see its revenues drop off because not everybody wants to eat at home. People want to go back to restaurants, but it will not drop back to where it was before. And that's what you're going to see as a permanent effect. In fact, I tell people I'm a great believer that every evaluation you're telling a story. That one of the things you need to do when you look at COVID is ask, how has COVID changed the story for my company? So I'll give you two extreme examples. If you're valuing a cruise line company, Carnival Cruise Lines, Norwegian Cruise Line, what has COVID done? It's destroyed your business. And what I mean by that is not only was 2020 a bad year, there's going to be a permanent drop in revenues because there are some people who will never, ever step on a cruise liner again. That story's been damaged. There's some companies that have clearly benefited. I gave you the example of Zoom, but I'll give you another example. I think COVID made Airbnb a much stronger company. You're saying, but people were not traveling in 2020. You know why it helped Airbnb? Because Airbnb is competing with Marriott and Hilton and traditional hotel companies, and COVID damaged those companies so much more that relative to them, Airbnb looks stronger. I think that's the reason Tesla has risen so much. While COVID was bad for everybody, Tesla emerged from the crisis much stronger relative to its competition than it was going into the crisis. So some stories are going to get bigger, some are going to get smaller, and that's going to drive how we revalue these companies post-COVID.
We are receiving some questions from our audience. So if you want to ask a question, just send it on our Facebook chat. So continue talking about COVID and different industry. What happened is that in the beginning of COVID crisis, probably it doesn't really matter where you put your money, that you probably lost money, but we see that countries and industry recover differently. So how is important industry and country diversification to maximize our returns?
First, let's look at how different countries, different industries did during COVID. One of the nice things that I was able to do during COVID, I was stuck at home, is every Friday I would download the market cap of every publicly traded company in the world. So I have access to S&P Capital IQ. And so I have 45,000 companies. I would download the change in market cap and look at what companies collectively did during the week, broken down by region, by sector, by industry. And if you look across 2020, it's true, globally, stocks made it all the way back. In fact, by the end of 2020, global equities were up about 10 or 15% more higher than they were at the start before the crisis. US equities made it back. But there were three parts of the world that were damaged by COVID, but they didn't make it all the way back. One was Latin America. The second was Eastern Europe and Russia. The third was Africa. What do they share in common? You're saying they're all emerging markets. That's true, but Asia is an emerging market as well, and Asia made it back well. What do Asia, Africa, Latin America, and Eastern Europe and Russia share? They're overly dependent on natural resource companies. Take Chile. Chile goes where copper goes. It's just the nature of the beast. COVID was much more damaging to natural resource companies. It was much more damaging for capital-intensive companies than capital-light companies. It was much more damaging for old companies than young companies. It was much more damaging for growth companies and mature companies. This was a very weird crisis because it was a crisis where private risk capital stayed in the game. You know what I mean by private risk capital, venture capital money, IPOs? They stayed in the game. Unlike other crises where they dry up, in this crisis, they stayed in the game. And because they stayed in the game, this was a crisis that rewarded flexible companies, companies that could move quickly, that could adapt quickly. So maybe this is the crisis that puts the 20th century to rest. Because we've been coasting off 20th century rules of thumb and principles for a long time. And it looks like the 21st century will belong to companies that are much more adaptable, much more flexible than were the companies of the 20th century. Maybe Tesla had the right idea. Building cars. Remember about 2 years ago when they had to build cars and they didn't build an assembly plant, they built them in tents. And people laughed at them saying, if you're a good automobile company, you should be building these big assembly plants. Well, maybe Tesla had the right idea. Maybe we need to spend less on building these huge assembly lines that cost a lot of money and tie up capital, and devise more flexible ways of production, of financing, of dividends. And that might be one of the good things that comes out of COVID is we recognize the value of being flexible. Now you asked a follow-up question about diversification. Let me address that as well. I've always believed in diversification, and I've believed in it because I think it's the height of arrogance not to be diversified. Because you're saying, I know the right market to be in, I know the right companies to be in. This is a world where there's so much out of your control. Remember we talked about how early in the process, I talked about when you value a company, there are all these macro things that happen that you don't control. Those macro things have become much more critical in driving value than they were 10, 15, 20 years ago. 2008 already taught me this lesson: spread your bets, diversify. But here's the bottom line: as we all diversify, guess what's happening? The correlation across markets, across companies, it's rising. The benefits to diversification are actually decreasing just as we all start diversifying. It's one of the ironies of investing is everybody's learning the right lesson. They're trying to follow the right lesson, but in the process, they're driving out the benefits from that lesson as they diversify.
Well, so I'm checking our Facebook chat over here, and many people are asking about ESG and how it impacts valuation. So what are your thoughts about ESG? And
let's step back. For something to impact valuation, it's got to show up in one of three places, right? It's got to show up in the cash flows. It's got to show up in the growth. It's got to show up cash flows, growth, or risk for it. So let's reframe ESG. For ESG to affect value, it's got to show up in one of those three places, one or more of those three places. Can a company become more valuable because it's a good company? Perhaps. For it to happen, what has to happen? It has to be able to sell more. Maybe its revenue growth is higher. Maybe its margins can be higher because it can charge higher prices. Maybe it can raise capital at a lower rate. So the answer is, could ESG increase value? The answer is yes. Could ESG decrease value? The answer is absolutely. By being good, could it cost you money? Absolutely. Could ESG do nothing for value? Yes, I could create a scenario where ESG does not. There's no ex ante reason where you could argue that being good always makes you more valuable. That's absurd. I've argued that the problem with ESG is the people selling it. They're overselling it and overhyping it and making it sound like it's going to be good for everybody. That's not true. There are some companies that may benefit from being good, some companies where it will have no effect, and some companies where it's going to hurt. And that's okay. And we need to be honest. Here's the other problem. What does it mean when you tell me you're a good company? I do this experiment. I do a session on ESG where I list out 10 companies. I'll actually list out 5. And I want you to think about ranking these companies from best to worst. Ready? Here are the 5 companies. The first is ExxonMobil. Second is Facebook. The third is Microsoft. The fourth is Apple. The fifth is Tesla. So let me repeat them again. ExxonMobil, Facebook, Apple, Microsoft, and Tesla. If I asked you to rank these companies from worst to best, Thiago, which one would you rank as the worst company? Yeah, you have 2 Thiagos here, so.
I don't know. I'm not sure. Maybe.
No, give me. I mean, good is, and this is the point. Good comes from your set of values, what you think matters. If you think climate change is the supreme problem we face, you know what's going to come out as the worst company? ExxonMobil. Why? Because it produces oil. But if privacy, you think, is the biggest problem we face as individuals, a lot of people are worried about what privacy, you know what company is going to come out as worst on that list? Facebook. Do you see where I'm going? I think when you talk about ESG, you act like we're all in consensus about what good means and what bad means. There is no consensus. Do you know that there are 5 different services that rank companies based on ESG? There's the correlation across those services is horrifically low. So if you look at 5 services, what they rank from best to worst, there is very little correlation. No surprise here, and that is not going to go away. So the first problem with ESG is defining good is really tough to do. The only sector where ESG has worked is fossil fuels. You know why it's worked? Because there's a degree of consensus on climate change. On almost every other social issue, there's no consensus. And if there were consensus, you know what would happen? You wouldn't need ESG. If we all agreed that privacy was the supreme problem, you know what would happen? People would stop advertising on Facebook, its revenues would collapse. You don't need ESG to do the right thing anymore. The very fact that if all these people talking about ESG suggests to me that the things they're talking about, there is no consensus on what's good, what's bad, what's best, what's worst. It's like being in quicksand. You know why people are selling ESG so strongly though? A lot of people are making a lot of money on ESG. Consultants, accountants, measurement services, bankers, they're all making money in ESG. But the bottom line is companies are not becoming better. If the end result of ESG is you want companies to behave well, not create costs for society, I don't think ESG is going to deliver that because it's going about it the wrong way. So if you ask me, what is ESG going to do? It's going to make a lot of people richer. None of them are going to be companies. None of them are going to be investors. They're going to be consultants, bankers, accountants, appraisers. And I blame the people who marketed ESG. The way I describe it, it's like eating cake and you get no calories. That's what ESG people promote it as. Oh, you're going to be good and it's going to cost you nothing. Being good costs. I mean, imagine going to church and the priest says, you need to be good this week. Being good will cost you. There are things you will not be able to do because you want to be good. Why is ESG any different? If you really want companies to be good, it is going to cost them. And the sooner we're honest about this, the more likely it is that we'll accomplish our objective, which is we want companies to behave well.
So another question sent by our audience, what do you see as the main competitive advantage in emerging nations, focusing in Brazil, of course? I have the feeling that commodities are the well-known advantages, but I've been wondering if you have another relevant feature to put into that analysis.
Are we talking about competitive advantages for entire countries? So basically what the competitive, so are we talking about companies or countries now? I'm not clear about that question.
So I think it's about emerging countries.
Okay, so what can a country use its competitive advantage? So let's go through some successful countries. What was Switzerland's competitive advantage? Secrecy, right? Secrecy and the fact that the Swiss follow rules. They're not like Brazilians or Indians who basically a rule or let's get around it. The Swiss follow rules and secrecy. So guess what? They built their success around secrecy and rule following. What's the Italians' competitive advantage? Extraordinarily good food, good wine. So their businesses that they've succeeded in tend to be. What's the Germans' competitive advantage? Attention to detail. The great German companies are engineering companies. So you ask me, what's Brazil's competitive advantage? So you tell me, what do you think Brazil's competitive advantage is? And you know Brazil a lot better than I do. What are its? So if you think about it as a country, what do you bring in? You can't say soccer anymore, right? I mean, that is not, I mean, that can get you only so far. It's you've got a very mixed, diverse population that could work in your favor, right? Because you could be, I mean, Brazil, you can, you know, you look across the city. I mean, you walk through Rio, Sao Paulo, parts of the city look Europe. I mean, you could mistake yourself for being in Europe, and other parts you're, you know, so it's a very, and that could, and at least within Latin America, your biggest advantage is a simple one, which is you're the biggest country in Latin America. You have size working in your favor. Think of how well that's worked for India and, you know, for China in Asia. Having 2 billion consumers domestically is an advantage. Brazil's domestic advantage is it's such a big part of Latin America that a Brazilian company can be entirely domestically focused and get away with it. But that's going to be much more difficult to do if you're a Peruvian company or a Chilean company because your markets are much smaller. Brazil can also be much more diverse than Chile. Chile, because it's a small economy, is going to be entirely dependent on natural resources for a big chunk of its GDP. Brazil has the capacity to have a more diversified economy. So I think that Brazil has advantages, but converting those advantages to actual payoffs takes discipline and it takes time. Neither of which Brazil seems to give itself. I mean, the last 22 years, as I've come to Brazil multiple times, it's amazing how often Brazilians have announced that they're now part of the developed markets. There have been periods in the last 22 years. Hey, we've arrived, we're a developed market. And then 2 years later, you're back to being an emerging market. It takes 3 steps forward, 2 steps back. Brazil's biggest challenge, I think, is political, not economic. And I mean, as long as you have chaos underlying the rulemaking and governments, you're going to have a much more difficult time building a long-term plan. It's very difficult for countries to plan long-term, especially if they're democracies, right? Because things shift around every 5 years, everything gets started. The only country I've ever been in, which has 20-year plans and actually means it, is Singapore. That's a scary, it's scarily well run. I mean, that's a country where clearly there's a long run plan. Like Singapore is a great case of how it's actually not even a country, right? It's a city state, has been able to create a niche for itself in the global economy. You know what Singapore's niche is? Like Switzerland, they're rule followers. They have a very well set up, and they have a legal system that enforces those rules scrupulously. There's no corruption, there's no bribery. So Singapore is marketing itself as the legal capital of the world. They're saying, if you're a company and you want to sue over a merger, don't go to the US. It'll take too long, it'll be too expensive. Come to Singapore. We'll give you a fair verdict. It'll take us only 6 weeks. It'll cost you 1/10 of what it costs in the US. And it's working. You've got to find a niche that you're strongest in, but then you need discipline to convert that niche into actual success. Brazil has a lot of advantages. I love Brazil as a country. but I think that it will need discipline and time to convert those niches into actual competitive advantages.
So another question that we received from our audience is also regarding tech companies and cash flows. I know you talked a little bit about that, but it's an interesting question. So the question is how to look at tech companies through cash flows, even if the company will only generate positive cash flows from 20, 30 years from now, and we have a huge uncertainty. So the question is, doesn't it make more sense for us to value that a huge cash burn now can make the company dominate a future sector? So the example that the person gave is about a food delivery company that is burning cash to gain more customer right now.
Yeah, so that's fine. I mean, the people price companies. Let's face it, most tech companies are priced, they're not valued. They're priced based on users, subscribers, and there are assumptions you're making. If I get a lot of users, subscribers, eventually I can convert them into earnings and cash flows. I don't have a problem with that story. But first, if it's going to take you 20 years to make your cash flows positive, I would give up on the company. Because remember, when you burn through cash, you need capital. Right? So even if you're right about the numbers being positive 20 years from now, you will need to raise capital every year for the next 20 years. You know what's going to get in the way of your story? If markets shut down, and remember, they shut down even in places like the US in 2001 and 2008, the VC capital dried up, young company capital dried up. If capital dries up, these companies will never make it to year 20. So you're more looking, even if these companies are successful, you're looking at cash flows turning around maybe 5, 6, 7 years from now. Uncertainty, though, you can't hide behind uncertainty. The fact that something is uncertain doesn't mean you cannot estimate it. That's the first thing. You still can estimate it. And if you're uncertain about it, why do you think we do discounting? When you do a discounted cash flow, what are you doing? You're reducing the value of that year 7 cash flow by a significant amount. You're already taking that into account into your discount rate and discount factors. So if uncertainty is the reason you're not valuing young companies, you got to let that go. You have to make your best estimates. You have to discount those cash flows at those discount rates that reflect your risk. And then if I have a value today, the value is very dependent on my turning positive in year. But the one thing I would bring in as an extra when I do valuation is the chance that my company will not make it. Because when you have a money-losing company with negative cash flows, there is a chance you will not make it, no matter how much promise you have. And I have to be realistic about what that chance of failure is and bring it into my value.
So I was just going to ask you if actually you were expecting a question that we actually didn't ask you. Were you expecting anything?
Well, I had no questions on inflation. So I guess inflation is no longer in your list of worries in Brazil. No questions about interest rates, because I think that's a big issue you can face across the world. Because, I mean, let's face it, we're in a world of low interest rates. We haven't seen rates this low in much of the world in almost a century. T-bond rates haven't been below 2% for almost 100 years. And low interest rates are should change our perspective on how much we can expect to make on stocks. Right now, US stocks are being priced to earn 6% a year, 6%. In the mid-1980s, if I'd gone to somebody and said, would you invest in stocks if I offered you 6% a year? There's no chance they would have invested in stocks. You know why? Because they could have made 6% investing in T-bonds then. The T-bond rate was 6%. Today, 6% doesn't look bad. You know why? Because the alternative is you make 1.5% to 2%. Interest rates being low has brought. So when you see companies using costs of capital and hurdle rates, and they're using 12, 15% hurdle rates, and these are US companies, I have to look at them and say, what universe do you live in? The world that we live in, a 6% cost of capital for a US company is about what I'd expect. For a Brazilian company, in dollar terms, maybe 8 to 9%. In reais, probably 13 or 14%. If you're using a 20% hurdle rate, let it go. Those days are done. And be careful about currencies. Currencies are measurement mechanisms. If I value Natura in reais and I value it in US dollars, I should get exactly the same value for the company no matter what currency I use. It's still a Brazilian company. It's still a cosmetics company. All those things will stay the same. All I'm doing is changing my unit of measurement. So when you think about currencies, don't be sloppy. Always make sure that you stay currency consistent. Whether you're doing capital budgeting, whether you're doing valuation, you have to stay with the currency you chose at the start of the process.
Oh, perfect. So unfortunately, we're getting close to an hour of our event, and we definitely understand you have a really, really tight schedule. So just before we end, and considering that most of our audience are undergraduate students interested in financial markets, what piece of advice would you give us all?
Take life in small steps. I know when you're 21, 22, 23, you want to change the world. You want to do it tomorrow. You want to revolutionize things. And that's fine. That's good to have those views. But remember, change is incremental. It happens one small piece at a time. So sometimes taking bite-sized pieces of change, saying, I'm going to change what I can, and I'm going to keep working, because this is a process that continues, is going to accomplish more than trying to do too much too soon. And I think that you're going into a much more uncertain world, the one that I came into as an undergraduate. Things are going to be shifting around, and you've got to think about what your niche is going to be in this world. And I tell people, do this. There's a very simple test you got to run, which is once you start your job, whatever job you decide to do, at the end of a work day, create a pie chart of how much you did that day was mechanical. You know what I mean by mechanical? Often when you have a job, you do the same thing over and over and over again. Make a measure of how much is mechanical. If 95% of what you do every day is mechanical, you pull the same numbers, you put them in the same types of spreadsheets, you compute the same ratios, I have some bad news for you. If much of what you do is mechanical, a machine can do that much more efficiently than you can. So when you talk about machine language and computers, they're coming for you. You're going to get outsourced if everything you do is mechanical. You need to think of something that you do that brings in your humanity. That's why I wrote the book on stories and numbers, narrative and numbers, because to me, that is what makes it unlikely that machines will be able to value companies well. Because valuation is all about the future. And as Thalissa pointed out, there's a lot of subjective, a lot of qualitative aspects. That's good. People often complain that there's so much that's subjective. I say, be glad there's a lot of subjective elements, because that's why I need you. Be less mechanical, be more conceptual, read less. This is strange advice because you're often told, go out and read more. Read less, we read too much. We live in what I call the Google search world. You know what that is? When you have a question, rather than think through an answer, what are you tempted to do? Go on Google and say, what tax rate should I use? And it's right there saying, that was great. I looked it up in 2 minutes. The problem with looking up everything, even if it comes from good sources, is you lose the capacity to think through an answer to a question. We learn by thinking through answers to questions. So before you use Google search, spend 15 minutes thinking about, hey, how would I answer this question conceptually? Because that is how you strengthen your mind, strengthen your capacity to be able to come up with an answer, and sometimes find better ways of doing things than what Google search will give you. Read less, think more. I mean, I live next to the ocean, and every day when I take my walk, I actually spend about an hour sitting there watching the ocean, thinking about something that's bothering me, something I can't quite understand. Say, why are there SPACs? SPACs are these big phenomena now. So about 3 weeks ago, I said, what's caused this jump in SPACs? What's so special about this market? And I wrote a blog post on it, reflecting that hour I spent looking at the ocean. I've discovered you're a lot more productive when you let your mind kind of wander and try to find an answer than read and try to get the answer from somebody else.
So on behalf of Poli Finance, I would like to thank you again, Damodaran, for sharing your knowledge and experiences with us. And I would also like to thank everybody who's watching us today. And with this, we reach the end of one more edition of Poli Finance Convida. Stay tuned in our social media for more content like this if you liked it. And that's it. Thank you.
Thank you.